Hi, Professor. In this presentation, I'm going to report on my portfolio management for WE Coyote Enterprises, Inc. So, I was assigned to manage an investment portfolio with a total value of 50 grand for this company in order to achieve at least a 6% return. Before jumping into the portfolio selection and allocation, I would like to briefly discuss the feature of a good portfolio. A good portfolio should have these five listed features. First is diversification. A well-designed portfolio spreads investment across assets to reduce unsystematic risk. Optimization of risk and return. Portfolios should be constructed to achieve the best return for a given level of risk. Third one is efficient frontier alignment. A good portfolio lies on or near the efficient frontier, meaning no other allocation offers higher return without extra risk. Evaluation and rebalancing. Portfolios should be regularly assessed and rebalanced to maintain desired allocation and respond to market shifts. Growth and stability balance. An effective portfolio balances growth opportunity with a stable, lower risk assets. Now let's get into our allocation. So as it's shown in the pie chart, 50% of the portfolio is split between Tesla and S&P 500 evenly. Also, 20% allocated to Amazon and 16 and 14% to Apple and Alibaba, respectively. Why we picked that holdings for our portfolio? Tesla leads the electric vehicle and renewable energy market. Despite market ups and downs, it's a growth stock that has delivered high returns. The P/E ratio as of July 2025 is 172 based on the last 12 months of actual earnings, which is considered extremely high. The reason for Amazon being in this portfolio is Amazon struggled in 2022 but came back strong in 2023 with Amazon Web Services growth and e-commerce bounce. It's a long-term winner with a reliable innovation. Amazon share value dropped in 2022 but gained over 80% in 2023 with a current PE ratio of 67.2. Apple is a city. People trust its products and its services like iCloud and Apple Music keeps growing. It gives us a stability and good returns. Apple declined by about 27% in 2022, but bounced back nearly 50% in 2023. And its valuation is solid at a P of 32.89. Alibaba gives us exposure to China and it's undervalued right now, even though it had negative returns 2 years in a row. The low PE of 14.33 suggests potential for turnaround. And the S&P 500 index fund is our safe zone. It tracks the market and gives us a steady long-term growth. It balances the riskier peaks in the portfolio. The S&P dropped 18% in 2022, but gained over 26% in 2023. And it currently trades at a P of about 28. So in this table, we can see the portfolio. Let's verify features of a good portfolio in this portfolio. So regarding growth and stability balance, Tesla and Amazon bring a strong growth opportunity, but also high volatility, while Apple and the S&P 500 provides a steadier performance, creating a balance between aggressive and stable investment. Optimization of risk and return. The mix of high growth stock like Tesla and Amazon with value oriented and steady performers like Apple, Alibaba, and S&P 500 seeks to maximize return without taking an excessive risk. Diversification by combining US tech leaders with international exposure through Alibaba and broad market coverage in the S&P 500, the portfolio reduces concentration risk and spreads opportunity across the market. Therefore, three features are checkmarked at this point. As we mentioned earlier, another feature is evaluation and rebalancing. throughout this project, I ran 3 assessments on the portfolio. The first status checked on July 23rd. As it's shown in the table, we have total gain of 2,200 with 4.47% overall return. All the assets are showing positive movement. Best performer up is Alibaba, up from $106 to $122, despite its low beta of 0.21, meaning less volatile than the market. Investor excitement around its changes led to strong gain. Tesla is the second highest return at 6.08%, consistent with its high beta of 2.36, showing high risk and high potential reward. Amazon moderate return of 1.45% with a beta of 1.36, is slightly riskier than the market, but showing a steadier growth. Similar to Amazon, we have Apple with a 1.42% return and a lower beta of 1.12, making it less volatile. S&P 500 modest gain of 1.58%, providing stability and diversification as the portfolio benchmark. So overall, the portfolio performance is positive, led by Alibaba and Tesla, because all the assets are performing reasonable and aligned with their risk risk profiles. No rebalance or reallocation was applied at this point. Let's move on to the second check on August 8th. So as we see in the table, the gain increased to 2,300 and portfolio ROI slightly increased from 4.47 to 4.77. Tesla ROI of 5.16%, showing solid short-term gains despite volatility. Amazon ROI, unfortunately, is negative 1.04%, reflecting underperformance and weaker capital efficiency rather than the other holdings in the portfolio. Again, Alibaba is the best performer with 12.78% ROI, significantly boosting overall portfolio returns. And Apple is strong ROI of 8.61%, driven by recovery after mid-period dips. S&P Index 1 stable ROI of 2.07%, providing diversification and risk control. So portfolio strength comes mainly from Alibaba and Apple, while Amazon lags. The S&P 500 adds balance, and Tesla contributes to steady growth. Now let's get to our final show. So this is the end of our portfolio management as of August 15. As it's shown in the table, we achieved the overall 6.1% return and $3,000 gain. So basically, mission accomplished. And let's see if we need any reallocation moving forward in order to verify the last feature of a good portfolio, which was efficient frontier alignment, making sure that this is the best allocation. I calculated M2 for each asset and ultimately for portfolio. M2 is risk-adjusted return, while ROI shows the raw percentage return. M2 adjusts performance for risk. The simple form of the formula for M2 is M2 equals Sharpe ratio times market risk plus risk-free rate. The risk-free rate is equal to 4.33%, and the market standard deviation is 15.9%. I retrieved the Sharpe ratio for each holding, therefore calculated for each asset, calculated M2 for each asset, and ultimately for the portfolio. So Tesla's delivered a 5.44% ROI, but when adjusted for risk, its M2 rises to 17%. This suggests that once volatility is considered, Tesla is offering much more efficient return. Risk-adjusted measures often reveal the hidden strength of asset with moderate ROI, which explains why Tesla adds meaningful value beyond its surface level return. Amazon reported only 2.67% ROI, yet its M2 is 19%, indicating very efficient risk adjustment performance. Although the raw return looks low, Amazon's stability means it produces a strong result relative to its risk. Efficiency is not only about absolute gain, it determines long-term portfolio health. Amazon fits this principle by balancing growth with lower volatility. Apple produces one of the strongest raw return with a 9.68% ROI, but its M2 is only 6%. This contrast shows that while Apple is profitable, the volatility reduces its efficiency on a risk-adjusted basis. Assets with high ROI but low M2 can expose portfolio to unnecessary fluctuations, which is why Apple, while valuable, should be viewed as a higher risk contributor in this portfolio. Alibaba stood out with a both 13.62% ROI and a 20% M2, making it the portfolio's best performer. It has not only produced the highest raw return, but also did so with excellent efficiency when adjusted for risk. High ROI combined with a strong risk-adjusted performance represent the most sustainable type of growth, which perfectly describes Alibaba's role in this portfolio period. The S&P 500 generates a modest 3.04% ROI, yet its M2 rises to 19%, confirming its role as a stabilizer. Even though the gains are smaller, the efficiency is high relative to the risk. Benchmark-linked assets often strengthen portfolios by reducing volatility while maintaining consistent returns, which is exactly how the S&P is supporting us in here. So the portfolio is showing both healthy growth and strong efficiency. The higher M2 compared to ROI proves that diversification is working and the returns we are achieving are sustainable relative to the risk. Thank you for your time and consideration. And these are some references I have used for this presentation. Have a good day.